Okay, we're live. Happy Real Fridays, Rick.
Yeah, happy Real Fridays, man. This is great. It's funny. I got a really good compliment from a institutional investor, kind of an investment banker, and he was saying that he really enjoys sort of watching our show. He actually watches the recording after the fact, and he was saying that it's a comment that I made with Jeremy where we might talk about rates, we might talk about mortgage lending and the makeup of the business, but we do it in a way that that is different. Like the idea is to try to sort of strip away the marketing fluff, strip away the talking points, and to really kind of unwrap the underpinnings of will rates go here or there. It's almost like he was saying. I made a comment once that like the National Association of Realtors had mentioned have really predictably have the lowest rate forecast of like about 15 different sources. They suspect that rates will end the year at around 5.6, 5.7%, something that like nobody really shares, right? No, at least right now in the present forecasting sort of models across about 15 different sources. And I just was like, well, of course, of course, the National Association. I mean, I love them. I love all the realtors out there trying to work hard, but when you're trying to paint the rosiest picture possible, and it just happens to be the picture that is the most self-serving picture. It's like, come on, there's got to be some realist. So he was saying that it's refreshing to have kind of a no BS, very sort of straight talk kind of discussion on mortgage, housing, and real estate, which is really the genesis of how we started with Jeremy around, Real Fridays and you and Jeremy.
Yeah, that's good to hear. Yeah, I always have more people mention it and listen, at least occasionally, at least to the recorded part than I expect. A lot of the executives that I work with that our lender partners listen. Never knew that. Occasionally comes up. It comes up a lot at conferences. I think the people that get out in the industry appreciate other people getting out in the industry virtually and physically.
Our audience makeup is pretty wide. Like we have a lot of industry leaders and executives, CEOs, and investment bankers are probably the first two or three that make up the pie chart of our viewership. Probably 2/3 of our viewership, and then the last is probably fintech, like vendors, and other sort of loan officers and that sort of thing. So it's a pretty diverse group, but it's a group of pretty thoughtful, influential leaders. Yeah. So I'm in Vermont right now, at my cabin where I do probably the best work. My brother lives up here, and my siblings live up here where I grew up. But it occurred to me what's interesting about the state of Vermont, and I think this is sort of a microcosm of where some of the housing inventory shortages sort of how local these issues really are. Vermont is a unique state, but it's not so unique but it's emblematic of what a lot of states do. Okay, especially states in like New England, New Hampshire, Maine is especially. If you own a certain amount of acreage, the state will actually pay you not to develop it. So there's hundreds of thousands of acres in the state of Vermont that simply are unbuildable. The state literally has taken it off the market for any kind of development whatsoever. And I know this, like I was looking at 100 acres just outside of Montpelier, and the way that it's zoned is that it's not a forestry zoning. It's kind of a preservation zoning where you can't build on it. Now, anything permanent structures, you can do tents, trails, but no permanent structures whatsoever. And I said, well, there must be some administrative way of appealing that or changing the zoning. And the realtor was like, good luck. It's not going to happen. And so that I said, what percentage of the land in Vermont is under this sort of non-developed? And he didn't quite give me an exact, I'd like to know the answer to that question, but he was saying that it's like hundreds of thousands of acres in the state that simply declared that the state takes tax monies and actually pays landowners not to build, develop on it, so long as it's in this classification, right? But once it's in that classification, you can't take it out.
Yeah.
So you have to wonder, like, how much. I mean, Trump can do whatever Trump can do on a federal level standpoint, but the problem is there's so many local intricacies around zoning and who controls the category, the classification, and the permits and the building of land. That it's really not a federal problem. And if conservatives want to make it a federal problem, then it becomes a problem. That becomes its own problem, right?
Yeah.
So I don't know. It's just
there's a lot there. Maine's super similar. The rule of thumb I knew growing up in Maine is that 50% of Maine will never be developed. It's probably not exactly right, but it's if you look at a map, it's pretty close. But Maine has a housing shortage now, Southern Maine.
It's massive. The entire state of Maine is under. And the problem is these states that are fairly progressive, Vermont being one. Like, we are in Vermont, very pro-immigration and very much a sanctuary type of state where we want to extend sort of the state's generosity to those who are in most need, like the immigrants in most need. The problem is there's no place to put them, right? And as a result, you get a lot of desperate people, and combined with the desperation of a lot of the immigrants, you get people who do take advantage of the state resources and the monies that are available to those more transient sort of populations. So as a result, you get people who are taking advantage of it with not the best of intentions, right? And so crime is going up. And there was a woman that was murdered not far from Stowe that was on that just a couple months ago, that was just on a nice hike, kind of a very similar story of the woman who got murdered at the University of Georgia campus about 6 months ago. And so now all of a sudden there's this pullback around, hey, wait a second, we don't know if we can, if we want to be generous, but at the same time we can't be too generous. Kind of like, it's a very delicate and inadequate way of describing it, but it's a real challenge. When you don't have housing for people become very desperate. I mean, it becomes a Maslow's hierarchy kind of motivation, and it's almost like you're doing people a disservice to bring them into a state or a community without at least a plan to be able to house them, clothe them, feed them, and educate them.
I'm excited. This is like I walked into a land use housing policy discussion, which I'm very interested. But I mean, the thing, Rick, that I always come back to is stable housing usually means stable communities, and stable communities tend to be more economically prosperous. So if what both parties want is economic activity that benefits business owners, employees, employers, we need our communities to be safe and stable, and we need housing to be safe and stable for our communities to be safe and stable. So to me, it's always been bipartisan, because you want stable, thriving communities. Also, that's who spends money. That's who patronizes businesses, small businesses, and everything else. So economic stability is the key to economic prosperity. And anybody who's trying to disrupt stability in our communities is probably not focused on economic or communities thriving. I mean, that's, to me. So, but I also think you hit on a second thing, which has plagued housing policy for years, which is we do a lot of drawing these arbitrary lines of what public funding can do and what public regulation can do and what private development or private markets should do. And I don't know that we're always drawing them in the best way, because what you just described, how do you keep people stable and in their homes, but also know that that comes with the infrastructure to feed and take care of people around them? We don't think holistically about housing, in my opinion. We don't do a great job thinking holistically. What we say is, in this industry, here's how we look at public-private partnerships. In this industry, here's how we look at it: healthcare, housing. education, and we don't look at them as interrelated because it's so heavy and complicated. So
Yeah.
we could do a better job as the housing industry showing that housing is the foundation, somewhat literally, I suppose you could say, about, but is the foundation of thinking more holistically about economic prosperity.
You know, there's a lot of thought around this, but I think what's hard is when you go to implement a solution, there's like a very narrow private sector solution. And I think we lost Jeremy. There's a very narrow private sector solution where, like, a company, it's almost like the mining town solution back out west, right? Back in the 1800s, where they built whole towns, and the town paid for it. Workers lived in it. You see this in Asia all over the place. They build in like South Korea, or even in Japan. They'll build these massive semiconductor facilities that house 5,000-10,000 people, and then around it they'll build a town just to house the people to work there Monday through Friday. They'll go home to their families for the weekend, right? Now, that's a purely private sector kind of solution, right? The problem with that is you don't get cultural investments. You get a very narrowly defined, like, house to serve my business objectives. And then when the business objective, like, is met, or expires, you get the old, ghost towns of the West, right? Where business moves out and then the town just dies, right?
Yeah.
And so, but this is what's hard is it if Senator Brock and Senator Jeremy and Senator Rock were together, and we were going to say, like, let's craft a solution where we're going to take, billions of dollars, put it into a fund, and have it go to mental health would have to be one, two, investments in construction for homes, three, public housing, right? Where there'd be public subsidies to underwrite that for homelessness, veterans. The question is, do you drug test them? Do you try to put any kind of accountability for seeking jobs? I mean, it ends up becoming like, but as soon as I start talking about it, there's kind of a conservative answer of like, no, you don't give them money for housing or for food if they're not drug tested. And then there's the Democratic answer of saying, well, that's kind of uncompassionate. They still need they still need a roof over their head. They still need food, right? So why put something fundamental and tie it to a necessity, right? Tie it to, like, whether or not you're on drugs or not on drugs, or in therapy or not in therapy. I mean, it's like the solutions get mired in ideology when
You're talking about how quickly they become social issues, how quickly fundamental pieces of either the economy or policy become a social issue, and how quickly those social issues become moral and ethical issues. So, like, I don't disagree with you that those things pop up right away when you start thinking about how to spend the public's money and where to spend the public's money. I think what I'm trying to say is, like, we've done a pretty one-dimensional job of constructing policy and spending money. It feels like to me, I know that's harsh to say because there are people listening who have worked their entire careers in housing policy and they're like, hold up, we've done all these different things. But I think what you're saying is, where it breaks down for me is, what do you fundamentally believe about stability of communities and stability of economies that will generate more profit for everybody, or that will generate more economic activity for everybody, or that will generate more private market opportunity for everybody. And so, like, that, so it does get all wrapped up in politics simply because you have to make a decision about how all these things interact and whether or not investing in stability means you get better economic outcomes for everybody. I believe it does. Regardless of whether you're the 99% or the 1%, I think community stability, economic stability is a key driver to our success in America. But, like, people seem to disagree, right? There's a lot of people who disagree with me and say, no, economic activity is a zero-sum game. And for me to win, somebody else doesn't. I have to take it from them. And if you believe that there's a limited amount of success or a limited amount of resources, then you aren't advocating for economic stability or housing stability. You're advocating for winners and losers. Like, Like, so I do think social policy gets wrapped up in all these decisions, healthcare decisions, education decisions, housing decisions. And I like that we're putting housing as so fundamental and core in our conversation. And I like this conversation because I think sometimes it's conversations like this, us coming at it from different angles, us coming at it without 50 years of housing policy bias. We may have a productive conversation, but I think that's why it gets so delicate so quickly. Just my 2 cents.
Do you think lenders should be, of all types, should just have, if you are a Fannie Freddie Ginnie, or if you have your HUD designation, or if you are a depository regulated by the OCC or the FDIC, then you should have an obligation to lend to, in essence, demographically minority communities. Like, because I believe there should be some kind of requirement. I believe there should be, whether it's an incentive requirement where you're so incentivized to do it, either through tax incentives or, I don't know, through some kind of regulatory incentive, or it's just a straight sort of market requirement that a certain percentage of your volume has to be this. So however you figure it out in the private sector, go do it. Because I find it sort of, the problem is, like bankers, we will go where the money is. We're going to go where the cleanest borrower, the fastest transaction, in balance with the lowest risk and the greatest margin, right? Sometimes risk and margin play an inverse effect with one another. The lowest risk loans tend to have the thinnest margin, and the highest risk loans tend to have the greatest margin to offset the risk. But the problem is, when you look at the average credit scores of us on the lending side, we're still 700 plus, 705, 710, 715, 720, when the majority of Americans are 640, 650, So it's like, and then you throw in immigrants to this that are either underbanked or don't have any credit at all. Look at Brock. You are a cat kid. You are a cat. Is that a kid? I know
what's that guy's name?
Kaya.
Kaya? Oh, I said guy.
Somehow I have pegged you, Brock. I've pegged Brock as a cat guy. That's
Jeremy's got what, 4 cats?
That's awesome.
I would like to point out there are 3 cats that live in my house. I don't know that I take responsibility for any of them, frankly, but there are 3 cats in my house and 2 dogs. So we're almost balanced.
My kids, we have 2 dogs, Forrest and Lily, Golden Doodle and Golden Retriever. I do like cats. I do love cats. In fact, we also have a cat as well that I can't forget. But like Daisy.
I like that you posed one of the most sensitive questions on like the ability to serve borrowers, and then pivoted into dogs and cats. This is how dynamic Real Fridays is.
This is what you don't
get on.
Real
Fridays is dynamic. You can go from economic justice to fair lending to cats and dogs. Look, I'll just say,
you got rid of him.
Did you think I called him out too much, huh?
Yeah, I skipped off.
I'm on.
Oh, he got a text. I was doing that earlier. Rick, I think that we tend to do this thing where we pretend that lenders, specifically non-bank lenders like IMBs, have more responsibility than they actually have. And we keep up that farce because otherwise the responsibility would flow to Fannie and Freddie, and we'd have to admit it. If you sit mortgage bankers down behind closed doors, they go, we're just a marketing front for AUS. We just do marketing and sales for the AUS. So how would you say we do marketing and sales for the AUS and then hold that organization responsible for who's in and out of the credit box, who's winning contracts in the housing market? Like, to me, we do apply that responsibility fair lending wise, especially when lenders are leaving out people who are qualified by the Fannie Freddie Ginnie box and they're not serving them they would be. But I don't think non-bank lenders have any tools, power, or capabilities to expand credit, to expand the Fannie Freddie Ginnie box. Yeah. So whatever the Fannie Freddie Ginnie box is, that's the best they can do. And then within that, are you overlooking otherwise qualified customers? That's a fair question and a fair analysis. But are those people winning contracts? Do they have houses? Like, is it the mortgage banker's responsibility that no selling agent or seller chooses a FHA borrower when they look at who should buy the house? Is it IMB's fault when the real estate community prioritizes cash first, Fannie and Freddie next, FHA and VA and USDA last? How are you holding lenders responsible for the fact that they can't help people win a contract? That's Fannie Freddie's problem. That's the real estate community's problem.
Yeah, no, I mean, you're 100% right. I mean, it's ultimately Fannie Freddie's problem. And Jenny, I think that, and that's going to lead to a question of concern. If the GSEs do fall out of conservatorship, which it seems like that conversation is gaining more and more momentum, then all of a sudden,
we can say it's done.
Then all of a sudden, it really is.
They are going to be out of conservatorship in 3 years.
But wouldn't you say, Jeremy? Then it's an entirely a public, because right now there's a public responsibility because of the full faith and credit from the United States behind the GSEs. If they become purely private, then all of a sudden it's a real private sector. It becomes their problem. Like all of a sudden, the onus will be we won't have that excuse anymore to say, well,
government did it for us. Yeah.
It's a really interesting question. Let me pose the question this way and see if this is right, because I like where you're headed with this. If Fannie and Freddie are regulated by FHFA the same way that like FDIC and OCC regulate a bank, for instance, if that's a similar style relationship, because Fannie and Freddie are always going to be quasi publicly backed because they have the charter. They have a congressional charter. So like they're always going to be somewhat backed in that sense. But let's even say they're implicitly or explicitly backed, coming out of conservatorship. What you're saying is like, if you subjected them to a fair lending exam, would they pass? And I think they would not. I think Fannie and Freddie would fail a traditional fair lending exam if you looked at their portfolios as a portfolio. But I don't know. But I think that's my hunch, is that less than 4% of the Fannie Freddie portfolio, less than 4% of the Fannie Freddie portfolio is what would qualify for like a diverse categorization. Apparently you can't get it to happen.
I can't get it to happen.
I don't. Are you on an iPhone? What?
I am.
I got the thumbs up, a heart.
Yeah, my kids do that.
Man, I don't know. Yeah, I love that. Anyway, that's my 2 cents. Like I said, I enjoy speculating on this because I think it is fundamental to GSE reform and what happens in the market afterwards. But I don't know the way to get at it. And what I mean by the way to get at it is get at more of that activity you're talking about without requiring it.
I just feel like these think tank, like Harvard's got their housing and economic policy sort of think tank around,
Joint
and there's
study, the Joint Center for Studies. Mm-hmm.
Yeah, but they have such a separation between the theory and the policy and the actual practice. Like there just isn't like where does the rubber actually hit the road with some of these recommendations? They become so esoteric and so academic that they're not actually like making its way into the head of secondary at a mortgage company that's going to say, I'm going to take this idea and implement it and train my loan officers to sell it and find the consumers to actually, like, there's just so many industry roadblocks to actually to actually clean up that pipeline between policy and practice.
So I'm going to do a quick shout out for realignment advice again with that for realignment advisors. Realignment is organized and created by a friend of mine, Chrissy Johnson. She and I work together at Rocket, and she has since gone on to advise companies in exactly this space. I'm sitting in a hotel where we try to have a housing policy meets innovation conference every summer called Realignment. Look, it is a massive opportunity with technology and the fact that the VC community has paid attention to fintech and mortgage over the last 10 years. There's a massive opportunity to connect the dots, Rick. I think in public-private partnerships, I think in GSE reform conversations, I think in the next 4 years, there's a way to have these conversations. It kind of does go back to the fundamental belief, though, that I was talking about, where you need better data, you need it transparently, and you need to believe that looking at it holistically helps everyone. And so like when you look at it as a zero-sum game with winners and losers, it is a much more difficult conversation to navigate because they're not trying to help first-time home buyers in all cases, in all communities. And so if you look at it as housing is fundamental to success and the success of a community, whether you own a share of your building, all of your building, whether you have, you know, really good buildings with really competitive rent, however you look at the housing spectrum, we should be connecting the dots better between practice and policy and between innovation and the people who can do it. To me, there's still a massive opportunity in underwriting data and in securitization data for secondary market players to come in and make a big enough difference that Fannie and Freddie don't have to. I know we've heard different hopeful Pollyanna views about PLS and different things for years, but I just think we're getting better and better data, and the economics are getting clearer on how you would manage an expansion of homeownership opportunities, you know, post global financial crisis that actually does work for everyone. But the rating agencies and a lot of the loan buyers are not there yet. So we have to get that frontline experience, data transparency, back into those worlds and stop, you know, siloing everybody. But I'm working on that. Reach out to me. I would love
I'd love to look at like just practical solutions that solve kind of the greatest like problems associated to home ownership, because there's such a massive population of consumers. I mean, there's probably, I mean, you could literally calculate the number of consumers that simply could have a home that rent. And there's a portion of that rent by choice because of their situation requires it for work or whatever. But there's the bulk of them that could absolutely buy, but they just either don't know how or don't have the product for them, or there's just no path from where they are to qualifying. I'd love to be more involved in the policy front, but it just seems like it's so fractured. I don't know. I don't see a clear, because I look at the Harvard, what was the institute called again? It's the Institute of Housing Development. Jeremy, he might be frozen.
I would say.
What's it called at Harvard? Yeah.
The Joint Center for Housing Studies.
Joint Center for Housing. Yeah.
Their most recent publication was also on supply. There is a supply side conversation here we should have about and I'll talk about where housing finance to me should play better with supply. Builders are skittish to overbuild. I think it's partially a hangover from 2008, but I think it's also just true of I got to manage to my shareholders and I have to manage to my return. So they're skittish. They own a lot of land. They're skittish to build. Fair. What we need to do a better job.
It takes too long to build.
We need to take our pipeline and we need to take our pre-approved customers and show them how many exist geographically. We need to do a better job of showing that in this area of Charlotte, in this area of Detroit, in this area of Tulsa, in this area of Seattle, we already have fully underwritten 2,500, 2,000, 1,100, 30,000, however many customers you have fully underwritten, ready to go. We don't do it. We wait and we wait and we wait to underwrite very last thing before we have to close. We need to figure out economics that allow us to underwrite early and often and show builders that we already have commitments on land. We already have commitments. We all have pre-approved underwritten people. We have to de-risk using housing finance tools, using fintech tools. Using fintech tools, we can de-risk builders. We can de-risk supply. We do not do that today, I don't think. And so that.
Demand gen, the builders need like better demand gen tools. Yeah.
Sorry about that. My Wi-Fi is going in and out. But I heard you, and I think you're right.
Yeah, the problem is the builders. It takes so long to build a home in the conventional way we've been building homes for 150 years, and so I just feel like, Jeremy, there needs to be a fast track 90-day process to construct a home, I'm not saying the government should prescribe whether it's concrete or whether it's 3D modeling or whatever the case may be. But I do feel like there should be financial incentives around, and maybe these are the federal incentives around loosening up some of the zoning requirements to incentivize states to give federal funding. If you do break this up, you get a massive amount of federal funding for economic development, but then also you incentivize builders to build in under 90 days. And then maybe they highlight specific technologies, whether it's 3D printing or, concrete, or brick or something.
I mean, I could tell you a short-term tactical policy change with this administration that would make a huge difference. A national building code for modular. So the same way that there's a national building code for manufactured, if they did a national building code for modular, and then FHA, Fannie and Freddie were all on the same page, you could go build to modular building code that is national, and it would, I think, incentivize and accelerate modular builds, which I've been a big fan of since I started digging into the supply side. So that would be an example to the audience. Support a national code on modular housing. It's not a big stretch because, first of all, we already know we can do it with manufactured, and then second, this is the private industry. This is private industry stepping in and using tools of the federal government to say, let's unlock new supply that's faster, more sustainable, and at a lower cost. It's only going to start at about a 25% discount or 30% discount to a stick-built home, but that's pretty substantial if you ask me. Like, that's enough. That's enough savings to justify let's get started, and then the savings will only compound from there.
And when that inventory exists, hopefully, then you can have better fair lending conversations too, because then there are homes for more people. Then you do have a reason, an economic reason for an IMB to come up with more FHA loans, to come up with more diverse lending products, to come up with whatever. Because it's so constrained right now. If there's only one house available, you're going to give it to the real estate community. To your point, Jeremy, is going to give it to the most qualified borrower or non-borrower. Might be SFR holder that pays cash. Everyone likes to talk about that. It's not as prevalent as people make it out to be, but it's still is a good example of like there's no reason not to sell to them.
So there could be targeted tax credits from a federal standpoint or even a state standpoint for builders to build this specific type of homes for modular, assuming a modular sort of national code for modular homes. And then there could be Fannie and Freddie discounts on these particular loan products for lenders to take advantage of to get better pricing. Almost like an LLPA, but based on product, not necessarily based on the pricing and the credit score adjustments. It's actually a product adjustment based on just to incentivize use of that product. And then maybe the third is maybe just some kind of tax credit on the materials for builders to take advantage of. So they incentivize to kind of, you almost have to create an economic vacuum to pull builders in that direction, either through rebates or some kind of tax, or rebates on one hand or tax credits on the back end. So rebates on the front end and tax credits on the back end once the project is completed and sold. I do like that modular conversation, a great deal. It's just that if you have no place to build it, this is where the zoning component, you have to have the incentives for the zonings to for states to increase it. But once that's been cleared away, then I think it's a matter of just filling the pipeline and the incentives.
I agree. I mean, I think also cities and states make competitive decisions all the time. Big cities are competing against each other. States compete against each other. We have seen it work in other industries where a state comes out and says, we're friendly to this type of manufacturing. We saw Miami get really super friendly with crypto. We saw Austin get pretty friendly with big tech. There are ways in which municipalities like cities, states, and federal funding can get tied to whatever the local community incentivizes.
Detroit got pretty friendly to mortgage, I would say. Mortgage industry employees.
I don't know that we've
I don't
know that we've seen the mayor specifically say like we're trying to attract more mortgage here, but certainly could.
You got subsidized housing for working for Rocket. I mean, when I first moved there, that's something.
Yeah,
but yeah, that was public,
that.
private, mostly private. But nonetheless, like, yeah, these things, there are microcosms of this. Big tech companies in SF did it in the 2010s. You know, yeah.
Minneapolis has been pretty progressive on housing, like thoughtful and innovative on housing. So like there are cities who are like, we want to corner housing as like our thing.
Utah built, there was a story not too long ago where Utah, for the homeless population, built homes for everyone who was homeless. And there was some, I don't know where they put them, if it was just sort of some central community. But it kind of gets to kind of the tiny home, kind of modular sort of suggestion of put them into housing, but there's got to be some way of rooting them into the infrastructure of the home there, and therefore the infrastructure of the community, rather than otherwise you just get a public housing situation. And that if there's no ownership or no tie to that ownership or no tie to the upside, then it just becomes a depreciating asset, not something that's going to appreciate, you know? But this is interesting. So the last comments I'll make, Jeremy and Brock, is that I was talking to an economist yesterday that he told me to keep his name out of this comment. And that was, he said, Rick, be prepared for 5% rates, 5.5, 5.6. And I was like, what are you talking about? I don't get it. Like, I feel like 7% is where the market should be. It gives I think lenders should adjust to 7% and then sell accordingly in order to maintain volume levels and to grow from there, rather than always relying upon some sort of, in essence, government handout of a lowered interest rate environment, production increases. It's like we should be building a housing infrastructure around 7 to 7.5%, kind of where we are right now. And his point was, look, Rick, Trump is such a wild card that there is sort of a Trump effect to this stuff, where if the Saudis pledge 679 billion in oil investments, Trump says, I need you to match, I need you to do that, and then increase it another 400 billion. So we need $1 trillion. And they do it, and somehow there's this effect, right? So his suggestion, without any really grounding of any consensus economically, is to say that it's just going to happen. Powell's going to cave. There's going to be some pressure institutionally on Powell to lower rates, regardless of the impact on, all these inflationary sort of, effects, and to lower the rates to be able to create this sort of, a housing injection. And so his thought was, be ready for that. And the second piece is be ready for the banks to get back into it as a result, because refinances are going to jump through the roof and the transactional volume is going to go up, both purchase and refinance. And the third piece is the consumer direct platforms are just going to win out, because now the technology with a lower rate environment, the technology is there to really deploy purchase power to these consumer direct platforms. And so these consumer direct platforms like Better and others are just going to catapult themselves back into the top 20. So the rise of the banks, rates in the mid fives, and the rise of the consumer direct tech powered lending platforms. I almost hope none of that happens, because my take is I want it to be 7%, and the industry should just flush itself out and invest and still continue. Like, companies who can't compete at 7% probably should be acquired, merged, or fold. Banks probably should continue the trajectory of shutting down their mortgage operations if they can't serve the consumer in a purchase environment, and continue to hold, where we are, versus throwing the industry another 200 basis point bone. You're on mute, Jeremy.
You're on Wi-Fi's not working. Yeah, I mean, I guess assumption one is that Trump is just going to find ways to put tremendous pressure on bringing interest rates down. I agree with that. I agree with that. Pressure will be there. I don't know. Does that executive pressure actually do it? I don't know. But like, you're certainly not supposed to be able to control interest rates. Still can't hear you, Jeremy.
Yeah, you're not connected. Oh, Oh, now are you on now? Switch from earbuds to like speakerphone on your thing, and just to see if that does it. Because I think I think it's like almost like you're out of something.
Yeah. But yeah, I don't. It's kind of the.
I don't know. I'm trying.
You're on.
You made it.
All I was saying was I don't think you can structure your business to count on fives. You can't hire to 5. You can't structure your business 5. If you structure your business to 7 and it happens to go to 5,
right.
If you can handle that volume, you're in great shape, because then it's gravy. Yeah. But you can't hire to 5 and count on it yet, I don't think.
Well, that's where the consumer direct piece would win really aggressively, is that they can take more, marginal costs are so much lower. So yeah, I guess it's like if that assumption is to be believed, that it goes to 5s, then the retail models and the banks and everyone else won't be ready for it.
Well, the servicers will, though.
Who will be ready for it? Servicers and online lenders and direct to consumer, right, will be the ones the most ready to take volume if it pops out of nowhere.
Yeah, I think the servicers and the online refi shops are the 2 best positioned if the servicers are doing portfolio management software. If servicers, if banks had put on their portfolio the alerts that let them know when somebody's in the money, like, they're in great shape. But if they haven't, then they're going to either, to Rick's point, cede that to servicers and consumer direct or not. So I would say that sounds right to me. All right.
So interesting.
So is the best scenario for the taking off? All right.
Yeah.
Housing debates. So is the best scenario for the retail loan officer, for the retail branch, not seeing much in rate drops, seeing more just stable 7s?
No. I would say the best scenario for the retail loan officer is that rates do go down to 5s. I'm looking at it more holistically, because I don't think it's like instant gratification versus what's better for people longer term, right? What's better for people longer term is to build an actual business that's going to grow production volume at 7%. I think it's better for the consumer, and I think it's better for our economy to give the Fed some leeway. Once you're at 5% or even lower, there's not a lot. Your federal instruments to help respond to an economic issue get really constrained. If there's some kind of calamity or a war or some terrorist attack or something that really impacts the financial system, it's hard to, you can only cut. It's like you can only pull your pants so far down, before they're down, right? Yeah. And so I do think that it being at the 7% is just more prudent, but to the loan officers will always say, "Shit, give me 4%."
Yeah, of course. But are they asking for their own demise a little bit if it turns into what Jeremy just said, with the servicers and the online lenders taking so much share?
Well, I do think there's a lot of unintended consequences, and I do think that the fintech community right now is so heavily invested in some of the, and especially investments in AI, is going to enable companies to scale in ways that they've never been able to, sort of profitably and quickly. And so I do think that we're in a much, so I think, to your point, I think that's a good way of saying it. I think it might be a shorter term moment of gratification, but longer term, it's like eating McDonald's. It's like you get it fast and it tastes good in the moment, but it ends up killing you in the longer run. I think it's going to be the same kind of thing.
Yeah.
But
people really do need the short-term growth right now, though. So maybe maybe it's still good for everyone.
Yeah. It'll be interesting to see. I'd rather see a 7% environment, and then you'll continue to see the attrition, but it puts pressure on lenders to operate faster, more efficiently, and more cost effectively in a flat sort of environment, so that you can grow out of it in that way. versus just having more units in the pipe because the federal government decided to sort of play a shorter term game.
Yeah.
And I fear that that's what the Trump administration will likely end up somehow cajoling the markets, you know, in a way that it does artificially stimulate, you know, the origination volume based on kind of a shorter term gain.
Yeah.
But with that said, well, you know, we'll see. You know, and they have the banks. I think I'm tired. I'm kind of tired of the banks, to be totally honest with you. It's like they should either learn to, play in the purchase space or stay as a niche offering for consumers based on what they service and what they portfolio. But I just don't think, I think, mortgage lending really should be a non-depository function because we do it better, more cost effectively, broker and IMBs than banks do. And, so that's kind of my sort of bias, if you will. But so I wish you could see this view, man. It is so beautiful. But it's
see some clouds through your sunroof or moonroof.
Oh, dude, it's just so nice. Like,
yeah, that is nice.
Like, I wish you could see just how beautiful that is. It is just so gorgeous.
Yeah.
And the green, that's Mount Mansfield right there, and Camel's Hump is off to the side, but Mount Mansfield is right there where the home of Stowe and Smuggler's Notch, and
I've been there.
So
nice. And you're gonna head to NBA IMB this week?
Yep, Austin. I'll be there Sunday till Wednesday. Very much looking forward to that. And then, are you gonna be there?
Yeah, I'll be there Sunday to Wednesday. Well, Wednesday I'm meeting with our team because a lot of my team's in Austin. But yeah, I'll effectively be at the conference Sunday to Tuesday.
Yeah. Are you doing a dinner? Like let's grab something to eat. That'd be great. I know I'm doing the Taylor's having a dinner for the community. It's Community Homeland, CHMLA or something, Community Home Lenders Association, his association, which is an excellent association. But Taylor is such an amazing leader. And so I'm looking forward to that. Cool. And then we have the Tri-State Conference here coming up. We still have to talk about, as far as what we're going to talk about. They wanted a presentation, and it's like, we can prepare some remarks, but the whole point is a more interactive conversation between you and I and whatever other panelists are, and those who are in the audience.
Let's just bring some data and then have a conversation. Yeah.
But yeah, no, I think we're going to know a lot in the next 2 weeks. I think a lot's going to happen, quite honestly.
Good time to be out in the industry. So I'm traveling a lot. I was in Vegas this week for our partner NewRes's leadership retreat I spoke at. Next week, IMB. Following week, going to another client site visit, and then the Tri-State, Maine, Vermont, New Hampshire conference with you. So busy 3 weeks of travel.
I'm a big fan of Barron. He's a hard ass, but I really appreciate his leadership style to some degree, and it serves a certain part.
Yeah, they were great.
It serves a real unique part of the market. It's they haven't been super strong in retail, and I think part of that is that it might be because of Barron as well. But I like Barron. I think that if he could be a little bit more retail centric, NewRes really could be a pretty strong retail, player in the space where they just simply really haven't been as much.
I only have so much insight, but I think they'll be expanding in a lot of the ways that you're thinking about. It's hard to build a business through mergers and acquisitions. They have the NewRes, Caliber, a few other servicing books and other pieces they bought. So I think there were a bunch of different pieces they had to figure out which ones were.
But acquiring a retail platform is, and they learned this through Caliber, which I think to some degree was an obviously painful acquisition, and one that that by probably any measure wasn't all that successful. But I would say that acquiring a servicing book is different than acquiring a retail platform, right? And there's the largest lender in the country that's acquired many mortgage companies and done it very successfully. NFM has done a number of acquisitions and done it very successfully. There's been a handful, very few that are really. Guild has done it really successfully. CMG's done it successfully. But for the most part, most companies really do it poorly, and you need to have the leadership, the temperament, the expectation setting, the deal structure. There's just a lot of the communication. Yeah. There's a lot of key pillars to a successful acquisition that I genuinely just don't see.
Yeah, but Neros has a lot of good leaders in place. Now I don't really know that much of the history, but we've worked with them for a year now. It's been growing. Yeah. Our partnership's been growing. Touches retail, direct consumer, servicing, retention. So yeah, it was cool to be there. Won't share too much. It's their stuff to share, but it was kind of an honor just to be a part of it with our partnership and getting to speak to everyone.
Yeah. Well, good, man. Well, I appreciate you, and I'm looking forward to seeing you on Sunday. Hit me up when you get to Austin.
Yeah.
But let's make this a wrap for Real Fridays.
Cool. All right. Talk to you later.
Take care, man. Take care, guys. See you later, Real Fridays crowd.